Hey guys, what is up? My name is David, and today we're going to be going over the 5 most important Warren Buffett quotes that every investor should internalize in order to better themselves at making investment decisions. I'll be going in depth and analyzing the meaning behind each quote and then explain how they apply to the value investing mindset. The first quote I'll be going over is arguably Warren Buffett's most popular, and that is, "We simply attempt to be fearful when others are greedy, and greedy only when others are fearful." This quote is often misinterpreted, and what he is really trying to say within this quote is if there is any irrationality in the market or with a specific investment, you should try to take advantage of this. By creating a bullish thesis and going through a specific industry and assessing a company's business models, competitive advantages, management, financials, and catalysts, you can clearly identify whether or not the market is being irrationally fearful about an investment and then proceed to invest in that specific company. When the market was down 35%, for instance, there were plenty of stocks that were down for absolutely no reason, but also many that were down for very good reasons. Being able to identify which stocks were down for no reason gave investors the opportunity to double or triple their investment within the next few years and take on minimal amounts of risk while doing so by implementing a margin of safety. The second quote is one which I think is a very underrated quote of Warren Buffett's, and that is, "Growth and value are part of the same equation." Many conclusions can be drawn from this quote, but the main idea is that growth creates value opportunities, and this idea has become increasingly relevant within the past decade. Value investors are putting their money in higher growth companies that are trading at discounts such as Amazon, Apple, Facebook, Google, and this is something which was often thought of as a growth investor approach. But the reality is, there is no such thing as a value or growth investor, just a speculator and an investor. Buying a company with higher growth makes it much harder to calculate intrinsic value. However, oftentimes intrinsic value is not what should be used to assess whether or not a high growth company should be bought. Rather, a culmination of assessing if the company is of high quality and is trading at a cheap price compared to their projected growth and past growth. This proves to be very effective at determining whether or not a growth-based company is undervalued using a value investing approach. Going off the second quote, Warren was also quoted saying, "It's better to buy a wonderful company at a fair price than a fair company at a wonderful price." I completely agree with this rationale. If a company is of high quality and is trading at a discount, the risk associated with the implied return is minimal, as opposed to a fair company at a wonderful price. There are exceptions, of course, to this, such as a fair company having the potential to become a wonderful company. But the point is that investors go through a company's business model, competitive advantages, management, and financials to determine whether or not a company is of high quality, and all of this has nothing to do with the stock price. A very small part of an analysis involves valuation. Before we get into the fourth quote, I'd really appreciate an early thumbs up as it helps the video reach more people and educate more investors. With that out of the way, the next quote is very simple and is just 3 words. Cash is king. Despite it being such a short quote, it is so important to apply to your investing style. No matter how undervalued you think your investment is, it is always better to have 15 to 30% of your portfolio in cash to allow you to take advantage of mass sell-offs. Having more cash when there are less deals means heavy outperformance when those deals inevitably appear. This is how Warren Buffett, for instance, is able to outperform the market in recessions and take on less risk while doing so. It isn't easy to hold cash, of course, because there's always an opportunity cost to doing so, but it is essential to ensuring an investor can flourish no matter the market conditions. The last quote I'll be providing insight to is, "The most important thing to do if you find yourself in a hole is to stop digging." Every investor at some point ends up making a bad investment or has an investment which has a business model that has changed substantially from the time of purchase. Warren is saying that you should not double down on that investment and just take the loss and learn from it. Warren put this quote to very good use when he sold his airline stocks at a loss, because he then realized the substantial risks associated with them and the flaw in business model associated with the industry. Don't be afraid of making mistakes in the market, because even the best of investors screw up at some point. The most important thing to do is to learn from these mistakes and not repeat them in the future. And that is how we as investors grow. Alright, so that is going to wrap up this video. I hope that these quotes have reinforced the importance of buying a high quality business with a margin of safety, and ultimately have helped you further build a value investor mindset. With that, please, if you haven't already, be sure to like and subscribe to the channel for more investing content, and let me know down in the comments what your favorite investing quote is. Catch you in the next video, and as always, do your due diligence and invest intelligently.